C Limited is one of the more interesting growth stocks I've been following in recent years. I've recommended the stock as a buy, and it's up considerably in 2024. Given the sharp rise in stock price since I rated it as a buy, viewers are asking if the stock is still a buy or if it's time to take profits. Interestingly, despite C Limited's rise in 2024, it's still down 77% off its high watermark. So I'll review C Limited's latest results, compare them against its longer-term performance, and of course weigh that all against its valuation to determine if C Limited stock is still a buy at current prices. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. I mentioned that C Limited stock has performed well in 2024. Year to date, it's soared from around $40 per share to begin the year, all the way up to $82 per share as of this recording. It's been one of my better performing recommendations of 2024. In its latest quarterly financial update on August 13th, C Limited management highlighted their success, saying that with the strong results delivered in the first half and our outlook for the rest of the year, we expect our Shopee brand will become adjusted EBITDA positive from the next quarter onward. We're also revising up our guidance for Shopee's 2024 gross merchandise volume growth to mid 20% range. And that's great news that one segment that had been negative in terms of adjusted profitability is now turning positive from the third quarter onwards. Furthermore, the digital entertainment segment, Garena, delivered a strong quarter with more than 20% year-on-year growth in bookings, and Free Fire had more than 100 million daily active players. So this has all been great news for C Limited and C Limited stock investors. As I highlighted, the stock is still down 77% off its high, despite the solid performance in 2024. Overall, the group revenue was $3.8 billion, which was up 23% year over year. For the e-commerce business, gross merchandise volume was up 29% year over year, and revenue was up 33.7% year over year. These are fantastic growth numbers for C Limited, which coming into the year was trading at a relatively cheap valuation, and I highlighted that as my reasoning why the stock was a buy to start 2024. The company goes on to say that in Brazil, its unit economics continue to improve as they achieved positive contribution margin per order of 9 cents in the quarter compared to a loss of 24 cents for the same quarter last year. So that unit economic improved 33 cents per order year over year. That's what I like to see with these types of businesses that benefit from economies in scale. I want to see evidence that they are definitely achieving that. And you see that here with C Limited. As their revenue increased, the unit economics per order became more positive. It turned positive from negative. So now every single order on the platform generates a 10-cent positive, and I wouldn't be surprised if that continues upward as the company's revenue continues expanding. Digital financial services segment revenue was up 21% year over year, and as of June 30th, the company's loan principal outstanding was $3.5 billion. That was up 39.5% year over year. Now, non-performing loans that are past due more than 90 days improved quarter over quarter. This was something I was a little bit concerned about. C Limited is the loan performance. Worldwide consumer loans have deteriorated given the solid performance they produced in 2020, 2021, and 2022. Worldwide consumers were more flush with cash given the fiscal stimulus that propped up worldwide economies. And now that fiscal stimulus has all but vanished, consumers are left with soaring debt levels at higher interest rates, and so default rates have increased almost worldwide. And so that was something I was concerned about in this particular segment for C Limited. It was nice to see an improvement. At least the trend wasn't continuing to move upward. Meanwhile, the digital entertainment segment increased by 21% in bookings. Quarterly paying users were up by 22% to 52.5 million. And the paying user ratio increased to 8.1% compared to 7.9% in Q2 2023. the paying user ratio is a percentage of users that are spending money on the platform versus just playing with free money. Most of these types of games have this type of business model where you can play the game for free, but if you want to buy certain items on the game, you have to spend money. And it's good to see that more and more users are spending money on the platform. It demonstrates that users find value in the game and they want to show progress in the game. They want to show that they're having better items, maybe a better avatar, better designs, etc. It shows that the game means something to them if they're willing to spend dollars on the game. Now, it wasn't all great news. One point of concern I had is the increase in sales and marketing expense. In the latest quarter, it increased by 57% to $774 million. That was up from $493 million in the same quarter last year. And that brought down the company's operating income from $283 million down to $83 million. The company gave little details on this increase in sales and marketing expense, but at least what I like to see when a company increases spending on sales and marketing is a subsequent boost in the company's revenue, which we did see for the company. C Limited increased revenue overall 23% year over year. So at least we did see a boost in sales that was much more than the boost in sales and marketing expense. Now, looking at the company longer term, you can see revenue has soared in the last 5 years up to $14.4 billion in the trailing 12-month period. And its cash from operations has also increased close to $2 billion in that time. So it's on a sustainable footing, generating $2 billion in annualized cash flow. That means the company doesn't need to rely on investors anymore for capital. It can fund its own growth from the cash flow from operations it generates. Additionally, the growth in the business has led to increasing return on invested capital, a huge improvement in this metric. While it's still negative at 1.95%, it's made great strides in recent years. And that's what I ask from companies like this. I want to see demonstrated progress in all of these key metrics, which I am seeing with C Limited. And finally, the valuation is higher than it was to begin the year, but it's still not prohibitively expensive. I would say it's trading more towards a fair valuation now. It's trading at a forward PE of 25. It was trading at a fraction of this valuation to begin the year. If I shorten this time horizon to just 1 year, around January when I first started recommending this stock, it was trading at a forward price to earnings in the very low double digits, 10, 11, 12, where I said this stock was a no-brainer buy, hand over fist. Now it's trading at a forward PE of twice that, but it's also demonstrated better growth. I would still recommend C Limited stock as a buy. So if you're asking me if the stock is a buy, sell, or a hold right now, I still think the stock is a buy. I don't think it's as strong of a buy as it was in January, February, when valuations were half where they are today. But I still think the company is trading at a fair valuation and it's demonstrating great progress across all its key metrics. So I still think the stock is a buy at current prices. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? Hit that subscribe button and I'll see you again soon.